there is the potential for someone to come after you for some portion of that $25 million. That is a liability that's sitting there. And you certainly don't want, as a company, to be the Lone Ranger guy who thought you were doing the right thing by giving people access to the one fund that generated 33% per year in 2006.
Welcome back to View from Above with John Berger. I am Garrett Lill. John, great to see you again. Are you watching any basketball this afternoon?
Not today. It's a little too early in the brackets for me to want to pay attention to it. And I don't have any dogs in the hunt. I don't have a school that I want to, go all the way through in March Madness. So I tend to back off on that. I have other things to do as well. So I'll probably, start picking it up in about a week and a half. And when things start getting narrowed down to the, final 16 or even sometimes I wait till the final four.
I'll probably be the opposite. I'm a pretty diehard UNC fan, so I will probably watch the early rounds, and then when we lose, I won't watch anymore. So,
well, there you go. You've already submitted that one into the reality book. So here we go.
Hey, I'm thrilled that we're still playing now. So we're already a little ahead of where we might have been. So. Well, wanted to dive in today on a topic that I know you've, I'm sure, had a lot of experience with. That even as even as an advisor for my first few years, I didn't realize this was even a thing. But the importance of having an investment policy committee on a 401k plan. And there are a lot of 401k plans out there that do not have any type of an investment policy committee, and even some who do may not necessarily know if they're doing it the right way or how they should be doing it or what exactly they should be doing on the committee. So I wanted to give you sort of a runway to share your experience on forming investment policy committees, what their purposes are, and just why it's so important for businesses to have them in the first place.
Well, let's even back it up further. It's not just the investment policy committee, it's actually the investment policy, right? So there are, sadly, several 401ks that I've had affiliation with or been in review over that are, especially they're kind of managed by a partner, and maybe they're doing something that's a little bit off the beaten path. So they have, maybe they're investing in things that they know because it's like a developer that knows real estate really, really well. So they're giving their employees an option to invest in what they know. But it doesn't matter whether it's something really hybrid like that, or you're trying to cut costs and just say, well, how hard is it for us to figure out what investments are going to be available to our employees? The reality is, whether it's even a 401k qualified plan or personal, you really should have a policy for those investments that outlines what investments you're willing to be looking at. What are the criteria for selecting one investment option over another? What are the performance requirements? Are you going to be, are you being tactical? Are you just being strategic? Are you just trying to create a sort of a well-balanced, highly diversified portfolio? What are the objectives of this investment wheelhouse that you're creating, and what are the criteria under which decisions might be made differently than just ad hoc? So what we're trying to eliminate is that ad hoc decision making that says, oh, well, when everything's going great, everybody says, well, just own, all you need to own is S&P 500 because everything's going great, right? So why would you want anything else? We want to make the most money possible. So just buy the investments that have the greatest return. Well, that's great if that's your policy, but that's not. It's hardly ever the policy. The policy is I just want to buy whatever is making the most money. Well, how do you define that? What are the rules that the people who are making the decisions? And when you get into 401ks and qualified plans, somebody somewhere is making decisions about what funds are available to the employees so that they can do whatever they want to do or choose, I'm going to do a date run path or whatever. Somebody's got to make those choices, and they have to adhere to simple rules like prudent man, right? Prudent investors. So, but what is the policy? What are you actually trying to achieve with this investment vehicle? And what are the criteria under which decisions are made about what is or is not in that investment vehicle made available, especially in the qualified plans, to your employees? So that's the first step. Now, when you have that policy, and by the way, the investment policy committee is the one that makes decisions about how the policy is executed, as well as does the policy need to be adjusted based on, could be a number of factors. Some policy committees will adjust the investment policy based on, market conditions, which is really not what they should be doing, but we see that as well. So the people who are on that policy committee really, I mean, they're defining what the investments can or cannot do. And if they're being ad hoc about the decisions about what is in or not in the policy or in that investment vehicle, you can see how it can just run amok really quick. So first step is got a policy. Next step is you have a committee that's making a decision about how that policy is being executed and what is in or not in the policy or changes that may need to be made about it. It's pretty complex.
When I was first out of college, I was a finance major and was working in banking to start with, and maybe shortly after that when I was in investments. But I had people come to me once in a while with their 401ks, and they would say, I want you to take a look at my 401k and tell me what I should do with it. And I probably wasn't really qualified to do that yet at that time, but I knew more about it than they did, so I would take a look. And I'll never forget, I would hear people say, well, I put it all in this fund because it's earning 33%. And I'm like, no. It earned 33% last year. Like that's not the same thing. Just
that
because
does
you
not
see that,
mean it will earn 33% next year, right? Past performance is no indication of future results.
But to these employees, I mean, these are people that are working in nowhere around the finance sector, right? They know nothing about finance, and that's understandable. But they're looking at a list of 25 mutual funds, and they're looking at performance numbers, and in their mind, that last 12-month return or 5-year average return or whatever they're looking at is the equivalent of going to the bank and putting your money in a FDIC insured CD that's paying that. Like they're saying this fund is earning 33% a year present tense, without even recognizing that is actually past tense. So I bring that up to say that's like one steamroller. On the other hand, you have a ridiculous amount of available investment options and financial professionals offering advice on what to do with it, talking heads on TV telling you what you should and shouldn't do. And you've got that steamroller on one side of complexity heading head on for another steamroller, which is a lack of educated, which is an employee base that is typically undereducated about finance in general. And these two things are coming head on 50 miles an hour at each other. And it can create, I don't have a word for it that I can use on the show without bleeping it out. But it can create a problem. Let's call it that. And the investment policy committee is sort of the buffer trying to keep these two things from colliding, right? They're trying to be a bridge between all the information that's out there and making sure that they put the menu together and form a policy that is going to help their employees make better decisions. And that can be a very complex thing because there will be people out there who swear by index funds and lowest cost possible investments. And if you don't have any low cost investments on your menu, then guess what? You may have some employees want to sue you for using funds that are too expensive. Or you may have nothing but index funds, and then you'll have people who want to sue you for not having enough active management. You may have no commodities on there, and now they want to sue you for that. So there are so many things that can potentially go wrong for your business if you're not managing these risks appropriately. And that investment policy committee serves as that buffer. So,
among other things, that's exactly the issue, and you don't want to. It's hard to get into that fuzzy part about your employees are going to make their decisions based on their experience, their ability, and you almost have to um, narrow those choices to something so they can't shoot themselves in the foot. Um, and it, because to your point, if things go off the rails, you have to have some level of your butt covered, for lack of a better term, right? It's unfortunate though because the whole system is, I can go down a really deep rabbit hole real fast about. So we're almost required to give performance over the last. We are required to show performance over the last 1 year, 5 year, I think it's 10 year, or at least the life of that particular fund, and by doing so, we invite every person that isn't seasoned as an investment professional. I mean, I know investment professionals that just fall back into the trap of, hey, past results is an indication of what I'm going to see in the way of future performance. I got 33% last year. It's going to do it again. It has to, right? So we're almost inviting that, but we have to show it. And like, if you don't show it, then what other decisions do they have, or material do they have to make the decision on which thing they should or should not be doing? And I don't think there's really an answer to any of this. It's just like, well, we have these rules and regs, and we do our best to make it as good for the employees as possible. But quite frankly, an employee will shoot themselves in the foot probably anyway. So we just want to make sure that what we're doing is not egregious.
This is on the process of forming the investment policy committee in terms of who should be on it, making sure that you're having a diverse selection from your employee base. How do you go about managing that process?
At this point, when given the opportunity, I just tell them, you know what, whatever platform your plan is on, whether it's Vestwell, Fidelity, they all offer investment policy committee for like 3 or 4 basis points, generally speaking, is the cost. It's next to nothing. And if you're a business owner that is not super qualified, I mean, basically has been in the trenches for 20 years as an investment manager, pay the money, have somebody else do it. They know what they're doing, and plus, you relieve yourself. You're paying to relieve yourself of any adverse consequences of the decision making made by that investment policy committee. They do it for thousands of plans. The committees that are with these platforms, they do it for thousands of plans. Yes, they tend to be a bit homogenized, but at the same point, they do it for thousands of plans. And the biggest thing you want to do with your plan is make sure that A, your employees are getting a good investment policy, and B, you are protecting yourself from adverse consequences if the employee shoots themselves in the foot.
How many business owners or key decision makers, CFOs or whoever's in charge of the 401k plan, fully understand the level of their fiduciary responsibilities and the amount of trouble that they could get in if things go wrong?
And I'd say a very, very small percent really understand and embrace it. They all do it because this is the right thing to do. I was supposed to have a qualified plan. My employees need it. I want to do something nice for my employees. And it's like, great, that's wonderful. And I try really hard to impress upon them, this means you are accepting fiduciary responsibilities, which means, that's a pretty high bar you're going to have to keep it to. And then I'll present them with, and here's a lot of ways you can make that high bar actually be achieved without putting yourself too much in the crosshairs for all of that responsibility, by basically deferring it and again paying somebody else to handle the vast majority of the really tough stuff. But unless you've been in a qualified plan, some of the larger CFOs, I'm sure that they've been in plans, been in companies that are large, and have had that company sued. The plan has been sued by a participant for something. And they have seen firsthand what that looks like and how difficult that is. Most of the businesses I work with are under $20 million in revenue. They just aren't big enough to have had that happen. So the vast majority of them have never seen it, tasted it firsthand. So no, they don't really understand the negative consequences of fiduciary duty and having that questioned, whether or not you did it.
And I don't know if this is going to fit in the rest of this episode. We very easily, I think, could have a standalone episode just talking about all the things that can go wrong in a 401k plan that you can be sued for.
Oh God, we could have like 10 episodes of that.
Yeah. I mean, that might be a whole new spinoff series we can do. But at a high, very, very high view from above level, kind of hit the high top 2, 3, 4 things that can be risk factors to the business itself from not properly managing their fiduciary responsibility to their employees on the 401k plan. What are the top 3, 4 reasons that they can get sued? Maybe is a shorter way of asking that question.
Well, they can get sued for not providing a reasonable, what they call prudent man option within the plan. That I think is probably the most prevalent one, where the menu of items that are available to be invested in is not a well-rounded menu, doesn't cover all the basic bases that need to be covered. They can certainly be dinged in the next major down cycle, because what happens, most of these things, sometimes they get sued when we've had 3 years of really great performance since near the end of 2022, and they say, well, the market did this, S&P did this, whatever, and none of the investments that were available to me came close to doing that. So we languish. There are going to be some people who are going to say, well, I didn't do as well as I could have done because you limited my access to it. But where those suits really come into play is when you have something like 2007 through 2009, right? So the market's down 52% peak to trough. The 401k is down 75% peak to trough. Or the market's down 52% peak to trough. Your 401k plan is down 48%. So you beat the market by 4%. But by the way, you're 2 years from retiring, and your 401k really just became a 201k. And you have a number of these people who are really close to retirement, and they're hot to trot because they were put into risky investments, or they put themselves into risky investments, and they didn't realize the risks that they were taking, and the market went the wrong way on them at the wrong time.
Yeah, and the diversity of the menu can be very challenging. I can remember sitting on investment policy committee meetings where there would be a hot topic of one person on the committee wants to put a gold fund in there, mm-hmm. or one investor wants to put a real estate fund in there, and they may be very savvy investors. They may know what they're talking about, and gold may go up 75% in the next 12 months. None of that matters, right? None of that offsets the risk of one employee putting all of their money in it, and it goes down 50%, and now you're sued for it, right? So that can be a rub sometimes, even within a committee. Okay, much less if you just got a business owner shooting from the hip, working as a lone ranger with no guardrails. But even within a committee, you can have disagreements on those types of things, because if you want to have a completely diversified, perfect, very air quote perfect lineup, you're going to have index funds. You're going to have actively managed funds. You're going to have target date funds. You're going to have just risk level funds like moderate risk, aggressive growth, these types of things. You're going to have a gold fund. You're going to have a commodities fund. You're going to have an energy fund. And then for every single one of these, you've opened up a new way for you to get sued if somebody misuses that.
Yes.
Right?
It's a two-edged sword, right?
Like, it really is.
You don't want to have too few, because then everybody's going to be complaining because, well, you didn't give me the option to invest in something that, in hindsight, did really well the last 3 years. And like, why didn't you have that there are so many ways to get dinged, and, it's just trying to keep everybody happy, which is impossible, which again is one reason why I just say, you know what, use the firms, use what's available to you, pay somebody else to take that hit. They have the ability, at least, to have the highest probability of creating something that is as robust as possible, and they're going to protect you from the worst case outcome, which is you're the Lone Ranger and you did something you thought was the right thing, but there was some adverse consequences you didn't know was possible, and they come along and they bite you.
Yeah. I mean, I'm an advocate for financial advisors in general. That's literally the name of my company, is Advisor Advocates. So yes, I am always a advocate for hiring a financial advisor. That being said, of all of the reasons that you might need to hire a financial advisor, the 401k plan and the offloading of that risk is by far the most one-sided risk versus return payoff you're ever going to make with a financial advisor, because it doesn't, the amount of cost that is associated with having an advisor guide you on your plan relative to the amount of risk that an advisor can help you avoid or at least minimize is so one-sided on that. And to your point, it's not even the Fidelities of the world that are sort of backing the advisors up. They have programs to support the advisors that are only 2, 3, 4 basis points, that are even adding another layer of protection on that. I mean, I can't imagine having a $20 million company and a $50 million 401k. That's a $50 million liability that you have, because whatever is in that plan is subject to something going wrong and you getting sued for. Right. It doesn't happen a ton, but when it does happen, it's catastrophic.
Well, yeah. So if that if your 401k is a $50 million 401k, and which is, by the way, larger than most of the ones that I'm dealing with, because I tend to be in the small medium company size. But if it's a $50 million 401k plan, and we have another 2007 to 2009, and now it's a $25 million 401k plan, there is the potential for someone to come after you for some portion of that $25 million. That is a liability that's sitting there. And you certainly don't want, as a company, to be the Lone Ranger guy who thought you were doing the right thing by giving people access to the one fund that generated 33% per year in 2006. And that's really what everybody dove into, and now you're kind of paying the price for that.
Yeah. Well, I think this might just be the tip of the iceberg. I think we could definitely do an episode or maybe even a mini series on a lot of these topics that we covered today, because it's definitely it's a very, very big onion that you can start unpeeling.
You can start peeling it, but going back to the basics of why does a company do a qualified plan? One, it's a huge benefit for your employees. It is a forced savings vehicle for your employees. You are helping them to build something for retirement. And we don't do pensions anymore, which is, it is what it is. We are now in the space of 401ks. So, and it's a great thing to do for your employees. I understand it can come off that it's like, well, it's just a Pandora's box of things that by bringing on this 401k, you're basically going to blow your company up because it's going to have a disaster. Markets are going to have disasters, and they do happen usually every 7 to 8 years. We're going for 13 now, but they do happen every every decade or so. And you want to make sure that your plan is designed to withstand what the negative ramifications of that can be for your employees. And there are ways to do that. And being cognizant of that is much better than just thinking, well, it's a great thing for my employees, so there's no downside.
Yeah. Yeah, it can sound like a big mountain of a risk, and it is, but only if it's not properly navigated, and that's where an advisor and your teams, right, can definitely be an invaluable asset to help protect against those things. So, John, why don't you tell listeners or viewers, if you are a business owner with a 401k plan or thinking of starting a 401k plan, how can they reach you so that you can be a sounding board and chat with them about their plans and how you can help?
So the website for Altus Wealth Solutions is altuswealth.com. There is a means by which you can just reach out, contact us, and you can ask for assistance with a review. And we'll move forward with the conversation there. If you have questions and you just want a quick consult just to understand some of the basics that we're talking about, those are free. It's not a 2-hour endeavor on my side. I can't do that, but I'm more than willing to have a conversation on the phone, help you sort of understand the lay of the land, and go forward from there. Whether you use me or you use another advisor, I'm just much more of I want to be that sounding board. And if there's something you're thinking of doing, again, qualified plans are great things. And don't get me wrong on that. They are wonderful. If you don't have one for your employees, strongly recommend you look into doing that. It is a great thing to do for the people who are working hard for you. It's just there are things that you want to keep in mind when you're getting it done, and understand that the costs that are put out there by the various companies that do these, they're real and they are there for a reason. They tend not to be outrageously expensive, but they are there for a reason because of the requirements of ERISA. So let's talk about what that looks like.
100%. Well, John, thank you for your time and your insights as always. And I will talk to you very soon, and we'll dive a little bit deeper into some of these other topics.
Sure. Great to be here.
Thanks. Have a great weekend. Talk to you soon.
Mm-hmm.